All right, welcome to Trading Nation. I'm Brian Sullivan. We're joined by Chiavarone now, who's going to talk to us about why he sees maybe another decade of gains for this bull market. I mean, Stephen, listen, I respect your views very much, but I'm a little bit wary of a decade of gains. How do you get to that?
Well, let's go through it. We think we're in the relatively early stages of a secular bull market. When we hit the market peak in 2000, it wasn't until 2013 that we said goodbye to that for good. And so as you think through it, what we think is going on is we're in the middle of an industrial revolution. Millennials are entering the workforce, but their wages are going to be under pressure their whole career. They won't make enough money to pay down their debt, fund their life, and fund retirement where there's no pension. So they're going to need equities. There's going to be a structural need for equities, and companies are going to become more profitable as they cut labor costs. And so that doesn't mean we don't have a recession. It doesn't mean we won't have 20% declines, but we think the risk is not being in this market, not being in it too late.
Okay, now let's dig in a little bit deeper here. International over the U.S. Be a little more specific. Would you prefer to buy more European stocks than American stocks right now?
Yeah, we really like Europe. So for starters, Europe's one standard deviation cheaper than it normally is. There's positive economic growth in every country in the Eurozone for the first time in memory. And you have a scenario where the banking system has finally started to heal. Capital ratios appear to be where they need to be. There's growth in the periphery. The currency has come off enough that European countries can actually compete against their Japanese counterparts. And these cycles of outperformance between the U.S. and Europe tend to last 6.5 to 7 years. And the U.S. has outperformed for close to 7. So we think it's now time for Europe to start to reassert itself.
You're not worried about the gains that much of Europe has already had?
Again, it's not just about the top line game. It's also about where the multiple is. And the multiple is still a standard deviation cheaper than where you are here. And they're arguably 2 or 3 years earlier in their recovery. So, no.
What about emerging markets? Last time I looked at your fund, FSTBX, he said, fairly heavy into some of the emerging markets. Is that still the case? Because that was as of the last filing date.
Yeah, so we're pretty tactical. It's a fund that can move very tactically in the markets. That's one of the attractive features. The way we look at emerging markets is we're selective. There's some structural issues in China, but stimulus has helped them have a pretty decent year. We tend to prefer emerging markets with younger populations that are tied towards really developed markets that are doing well. So think Mexico, pockets of Eastern Europe, even India, now that they've gone through some of their fiscal issues. But in general, we're more neutrally positioned today, but still a little bit overweight.
And what would you be underweight? What around the world or domestically simply does not look as attractive to you guys?
Yeah,
any positions you've left recently?
Well, let's talk sectors, I think, there. We tend to like the growth of sectors that we call our 3% basket. So we really like financials, energy, industrials, materials. We're less positive on some of the more defensive sectors. So we think staples are quite expensive at almost 19 times with the structural threat of Amazon. We think that traditional retail, I know that's kind of beating a dead horse here, but traditional retail, to kind of sum it up, when Amazon bought Whole Foods, its stock price rose more the next day than the total cost of that acquisition. The market paid Amazon to buy Whole Foods. When you're up against a company that has a zero cost of capital, that's incredibly difficult. We think telecom is a little bit structurally under pressure, both on the cable side, but also just in terms of the price war, amongst the carriers. So we would tend to focus on those parts of the market that would benefit from a pickup in growth, which is what we expect.
Chiavarone, Federated. Stephen, a pleasure. Listen, as somebody with a 401k, I hope your prediction is right. I mean, the millennials
so do I.
Will take this market to a new level. They get knocked a lot, but if they're going to push the market up, good for the millennials. Stephen,
you heard it here first.
There you go. Chiavarone. Thank you very much, Stephen. A pleasure.
Thank you.
Thank you. And folks, as always, thank you for tuning in to Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.